Okay, everybody, welcome back to Frankly Finance. So this is week 8 and we are going to be going through debt. So just to recap, if you haven't joined us before, I'm Gemma Mitchell, financial advisor and money coach. And we have Lexi Smith here, who has also a background of being a financial advisor and now a money coach and educator. So we're here every week at 11 a.m.
I was just thinking, Gemma, isn't it amazing how when you do something consistently and have an accountability partner to show up to, how you can achieve so much? Like, it blows my mind that we have been here 8 times and done 8 episodes, and it wasn't actually that hard. It's just about showing up. And I think the same applies for personal finance. If you've got an accountability partner and you keep showing up, things happen.
Yeah, well, we'll be able to say that when we're on like episode 800. So this week we're talking about debt. So last week we were talking about a few different things and we got onto the subject of consolidating and things. So we thought this week would be really good to dive into different types of debts, some things that people don't consider. And Lexi's got some good tips on different kind of debts that suit people that even I didn't know about, that she just told me about before. So that's exciting. But before we jump into it, Lexi, do you want to give us a bit of an idea on what you're going to talk about?
I don't even know where to start. There's a lot to unpack with debt. There's lots of different types of debt. Maybe we can start with the different types. So first we have a mortgage, a home loan. You've got credit card. I would say that they would be the most popular, closely followed by car loan. You've got help debts if you've studied, payday loans. I really don't like payday loans, but a lot of people have them. It actually upsets me that they can be advertised. Like, I remember we went to the footy not long ago and the ads are plastered all over the field, all over their clothing. So you've got people who are gambling, betting on the games, and then seeing these payday loans pop up and getting into a lot of strife. So that kind of upsets me that we can't advertise, smoking, for example, but we can advertise payday loans. And I think that's something that really should change.
That's exactly it. Like, that's totally against the gamble responsibly and all the other things that they've put the disclaimers everywhere. But yeah, then they're doing that. But yeah, I totally agree with all of those. And then there's your other loans, like investment loans for an investment property or a share portfolio, or, your business type loans as well. But I guess it's important to kind of realize why there's different types of debt. It comes down to 2 categories, which is secured and unsecured debt. So a secured debt is when there's an asset there, like collateral assets. So for example, a house, a car, if you buy it as a secured loan, or an investment property or a share portfolio, there's something there that if you can't make the repayments, whoever the lender is, they can take that asset back to recoup their costs. So secured loans are generally a bit cheaper in interest rates and things because there's a bit less risk. There's something there that the lender can actually recoup if you were to default on it. Whereas unsecured is most of those examples that we went through, like a personal loan if you used it for a holiday, a buy now, pay later, like they can't come and get the dress that you bought online. So these are unsecured. You generally pay more interest for those types of things because there's more risk on the lender that they're just hoping that you can actually make the repayments. And if not, they'll go after you for some other things, which will be a lot more, it's a harder road for them to recoup any lost capital.
I've had discussions with a few people over the years where they just had no idea that they had the 2 options with the car loan, and they didn't realize the impact that that was going to have on that interest rate. Yeah. Speaking of debt and interest rates, I think it's crucial to know what your interest rates are so that you can better have a plan in place. I had clients really recently who were adamant that their car loan interest rate was 4.9%, and they were pretty comfortable with that given their home loan was higher than that. I got them to go away and double check though, and it wasn't 4.9%, it was 8.49%.
Yeah, and where people get tripped up with this, especially with car dealers, like this example, is the advertising is from this rate. But it's not until you actually, for most of them generally, it's not until you sit down, do the application, and depending on how strong your application is, your credit, all of that kind of stuff, it will come back with a rate offer. So for example, it might say from 4% or from 2%. and you sit down in front of them for that particular car, you might actually get a rate offer of like 12. I had a client just last week who was like, oh, they've offered us 12 point something for our car loan. The car's like $80,000. So yeah, but it's advertised to get you hooked in to make the decision that you're emotionally invested in that car. And then at the point where you're in finance, you're just like, oh, well, I've already made the decision and I'm just so excited for this car. You're already so far down the track that you're kind of just like, oh, interest rate doesn't matter because you've already made that purchasing decision. It's already done. It's very, very clever.
That would then lead into a discussion on how to tackle debt. Like, if you've got a number of debts and you've got some surplus to pay more towards than what your minimum repayments are, how should one go about deciding where to put that additional surplus to pay down their debts faster if they have, say, a credit card, a personal loan, a car loan?
Not personal advice, but there's two main strategies, which you'd probably agree, wouldn't you? There's two. Maybe there's another one out there.
You're going to be talking about the ski season?
Yeah. I'm sitting here in Sydney, it's freezing. Yeah, so there's two main things. If you read your finance books, you go online, there's two main strategies that I see are most common, and it's the snowball method and the avalanche. And then, of course, there's a consolidation. So there's probably three main ones. So last week we talked about consolidation because people generally think that it's the best way to go, but depending on the loan that you're consolidating and how long you're going to be paying that off for example, rolling it into a mortgage, you might actually be paying a much smaller interest rate, but over a much longer period and be worse off. So we touched on that last week, but let's talk about the snowball and the avalanche. Do you want to go through? You go through one and I'll go through the other. We'll see if we're on the same page.
So I think, big disclaimer to start with, there is no one that is the perfect option because what works for one person isn't necessarily going to work for the other. So with a snowball method, you start by listing out your debts smallest to largest. So if you've got a $500 credit card, a $12,000 personal loan, and a $40,000 car loan, it would go in that order, smallest to largest, regardless of the interest rate. And so what that allows you to do is to feel that sense of winning sooner. Because let's say the personal loan was the highest interest rate. If you were paying extra towards that to try and get rid of it because it was a higher interest rate debt, it would make the most sense from a numbers point of view. Then it would take you a very long time to get that sense of, oh, okay, I've gotten rid of one. But if you start with the $500 one, you get rid of it. And in a sense, it's also consolidating the number of loans that you have just in a different way. So that's the snowball, starting with the smallest debt first, putting your minimum repayments towards everything, but anything extra that you have, putting it on the smallest debt and then moving down the chain. And then avalanche then is that more, from a numbers point of view, works out better because you're paying off the higher interest debt first. But yeah, it depends on the person and the situation as well as to what method might work better.
Yeah, I think it comes down, when I talk to people about it, it comes down to your personality and your money style and things and what's going to motivate you to keep going and make the biggest impact, because it's such a hard slog when you've got debts. And if you are actually paying the highest interest first, yes, it makes sense from a numbers perspective, from a math perspective, because you're paying off the one that's costing you more, but that might be the bigger loan. So that feels like a hard slog. Like, I'm the type of person that if I've got a list for the day and I've done something that wasn't on the list, I put it on and cross it off so I get that little dopamine hit. Yeah. So while I'm numbers very focused, I'd probably be more inclined for me to go the snowball and get rid of the ones first time, checking more stuff off, just because I know that's how I would keep me motivated and excited and see progress. Because if you're going the other way, it can be a lot longer until you see progress. But from a numbers perspective, it absolutely makes more sense. So you got to find what works for you.
And I think when you write it all down, you might be able to clearly see the best way to do it. And what I mean by that is, let's say you have an $11,000 debt and a $12,000 debt, but the debt on the $12,000 debt is double, you might have thought like, yeah, I want to do snowball. I want to start with smallest first. But if they're that close, you're probably better off looking at the higher interest rates.
You could absolutely do a combination. You could go, I'm going to focus on the avalanche, but these are really little, so let's just get rid of them first and then a clean slate. Yeah, it's about just picking what is going to work from each strategy and adapting it to your life. There's no hard and fast rule. But on that, which we were talking about earlier, the other thing people don't realize, and I mostly see this with car loans, is that sometimes the interest that you're going to be paying is already calculated and set. It's like a condition of the loan. So sometimes repaying debt early is great because it's off your list and you can move on to the next thing. But potentially you might actually be paying the same amount of interest regardless as a penalty for paying it out early. So an example might be you have a car loan for $20,000 and $3,000 of that is interest, for example. The car was 17. If you pay it out early, you're paying the whole 20 grand regardless. So this is important when you're looking at getting a car loan or finance. You want to look at the terms and conditions. Can you repay it early? Are you paying monthly fees like an account fee plus the interest? If you do repay it early, is there different penalties a year in versus 2 years in, or are you going to be paying the interest regardless? So there's so much to consider. But yeah, the ones that I think are the trickiest and all that stuff is really hidden and people get really confused, I think is like the car loan example, right?
And I think the point that you make with that is really key, because we've got some like general guidelines around things, but you really have to look at the situation in isolation to come up with a bit of a plan. I was always, and this is from my childhood, always being told never get a car loan, always save up for your first car. And that was really drilled into me and has kind of followed me. But there was one point that Ben and I decided to get a car loan, because in that particular situation in that year, we were building a house and we had our over 20% deposit. And if we had have bought the car outright, though, that would have dropped. And that would have meant that we were going to incur lender's mortgage insurance. And so we made the decision to be a little bit strategic around it. So yeah, I wouldn't say against car loans, but try to avoid them where possible. But then there are situations where it might make a little bit more sense.
Yeah, that's being strategic, right? Which you should always be with your finances. Consider the trade-off that yes, there's a benefit and a disadvantage for both ways and which way makes more sense. So I'm very big on debt is not a bad thing. Debt gets you where you need. Sometimes debt will get you where you need to go, right? So sometimes you're not going to be able to get a car or get the business set up without a business loan or get into your property without a loan. So debt itself is not a bad thing, but you just need to be really, really mindful, have a solid strategy around it. And remember that while debt gets us where we need to go, it's also an accelerator. So if things go well, like gains, for example, a property gains and you took debt on it, that's amazing. That debt helped you make a big profit. But it can also accelerate losses. So when you're buying a car, if you buy a property that goes down in value, your losses are larger because you've lost on the asset and you've got debt still to repay regardless of what that asset's worth. So the bank doesn't go, oh, you owe us 20 grand, but the car's now worth X, so don't worry about the difference. Like regardless, you are paying that debt back. And the other thing people don't consider is your house or your car, whatever the debt was X amount. All the interest that you've paid means the debt actually cost you like this much. So you might think, oh, I made a profit on whatever I bought. But when you consider the expense, like if you go on a home loan mortgage rate calculator and you like borrow 300,000, but you repay 800,000 or something, like, so it doesn't always, the profit that you feel like you've made isn't always accurate. But yeah, debt itself is not a bad thing. At some point, everybody needs debt. It's just about being really smart with it, I think.
And there may be a situation whereby someone needs to go into debt for not something like a car or like credit card debt in terms of consumer spending, but something that they need to have a roof over their head or to be able to drive to work. So if there's something that not a lot of people realize, including you until we had the discussion, is that there is something called NILs, which is no interest loans. These are available through Good Shepherd and Vinnie's as well. They're the two that I'm aware of. And there is no interest. There is no charges. There is no fees whatsoever for the life of the loan. It is only available for small amounts for specific purposes and for certain people though. So as an example, if you need to pay your rates, you can get up to $3,000 as part of this scheme, but you have to fit into the criteria. So one is having experienced domestic violence in the last 10 years. Then we've also got some income ones. So if you've got a healthcare card or a pension concession card, you can access. The other one is if you're a single, your income, if it's under $70,000 a year gross, so before they've taken out tax, or if you're a couple or have a child, then it's $100,000. So I think there'd be a lot of people out there who might go and put something on a credit card, maybe car repairs, for example. You can get up to $2,000 for that, where they're then paying maybe 20% interest, where they could have made an application for nils and paid 0 interest. In terms of repayment time, you've got up to 24 months. It's all arranged when you do it. But yeah, just for others to be aware of that there are certain things like this that are available, that if you're eligible, take advantage of it if you need it.
Yeah. And I think there's so much like guilt associated with debt, because we always hear debt is so bad and all this kind of stuff. So there's so much guilt around it. And when people are trying to repay it, a lot of the time they are feeling guilty, embarrassed or something because of their past mistakes. So I think it's really important to forgive yourself for what you've done, so you can just focus on changing the behavior and making the repayments. But yeah, if you're eligible for any of these kind of support and you're going to have debt anyway, then get the absolute best deal and see what's available to you. And if you're on Centrelink, like they've got options there as well. So for example, I recently got like dental work done, and I am also settling on properties and stuff. And so I had the cash to pay for it. And then I was at the dentist and they were like, oh, we have this payment plan thing. And I'm always against that. Like I was just like, nah, I'm paying cash. But then I'm like, well, going through a divorce, I'm settling on all these loans and everything's a bit up in the air. I looked at the fees and everything and worked out, well, even if I did that for a year until all this is settled, and I might still have my cash and I'll be able to pay it back. But I was like, yeah, that absolutely makes sense for me. And I'm happy to pay the expense of getting the debt, just so I can go, oh, I've got a bit more of a buffer, and when everything settles, I'll pay it off. And so it might be that, yeah, you don't need to take on the debt, but strategically it helps you accelerate in another area, like with your house example. So we're not totally anti-debt. I think every time people think about speaking to a money coach or a financial advisor, they're going to be told, no avocado, make your coffees at home, don't have any debt, like you'll be shamed for all this kind of stuff. But like in this example, I literally have this like dental loan random thing. So yeah, it's just whatever works for you.
You mentioned getting great deals. So this is something that I have a lot of conversations about, with interest rates for home loans specifically, and them not being competitive. So sometimes it is just a matter of picking up the phone. This is life